Wall Street institutions found a new gold mine to park their money: single-family homes. And over the last number of years, these institutions have been buying up starter homes across the United States. That way they can rent them out. The problem that some people have with this is that it created a couple of issues. Number one is that you might end up in a bidding war with a hedge fund. And number two is that the inventory of homes are so low, and this might be partially due to hedge funds buying so many homes. That's why now there's a new bill being proposed to ban hedge funds to be able to invest in and own single-family homes. The bill would then require hedge funds, which are corporations, partnerships, or real estate investment trusts that manage funds by investors, to sell off all of their single-family homes over the next 10 years. And fittingly, the name of the bill is the End Hedge Fund Control of American Homes Act. Now, my goal of this video isn't to talk about the legality of the bill, because that's more of a legal and political topic. Instead, I want to talk about what's going on in the housing market and really understand how hedge funds have affected the housing market. That way, we can really understand the truth. First, just so we're on the same page, how many homes are hedge funds and investors really owning? This is a chart from Freddie Mac that shows the share of home purchases by institutional investors. And what you'll see is that at the peak, institutional investors are buying right around 2.5% of the homes available. By the way, based off of their definitions, an institutional investor is somebody who purchases at least 100 homes over the last 12 months. But let's take it one step further and dig a little bit deeper into all investors. This is another chart from Freddie Mac showing how many homes were owned by investors over the last couple of decades, actually a little bit more than the last couple of decades. And this includes mom and pop investors. It also includes institutional investors. And what you'll see is that right now, at the time of recording this video, about 30% of homes are owned by investors. This is higher than where we were back in 2000, but it's below the peak in 2012. That being said, have we seen an uptick in institutional home ownership in the last few years? Yes, absolutely. But is institutional home ownership, hedge funds, the reason for the housing crisis that we're seeing today? No. There are other issues that are affecting the housing market. What are those issues? Well, we have an imbalance of supply and demand. What happened over the last few years? Well, the pandemic came in 2020. Then we saw interest rates go to the lowest levels ever. Then we saw everybody want to move from the cities to the suburbs. Then you had people that want to go out and take advantage of these low mortgage rates. So everybody wanted to go out and buy a home, but we didn't have that many homes available for sale. So that caused home prices to skyrocket upwards. Then the Federal Reserve Bank kept interest rates near zero, even though inflation was becoming a problem. Then you continue to see this influx of buyers into the housing market, so home prices continue to rise. Then, in 2022, the Federal Reserve Bank realized that there are consequences to inflation, to all the money printing, to low interest rates. So the Federal Reserve Bank started raising interest rates in 2022 at some of the fastest rates we've seen ever. So then we saw mortgage rates shoot up from around 2.5% to over 7% in just about a year. And this then created a very unique situation in the housing market where home prices shot up by over 40% in just a few years. Now you have home prices way up here, and then mortgage rates went way up here, and home prices stayed high. Because normally what happens when you raise interest rates is asset prices fall. However, we raised interest rates so quickly that we didn't get to see the decline in asset prices yet, because generally it is a slower moving process. I mean, just think about it from the perspective of a homeowner. You are more likely to raise the price of your home than you are to cut the price of your home. Because if you're listing your home for $400,000 and somebody offers $425,000, you're going to say, yeah, I'll take $425,000. But if you're listing the home for $400,000 and somebody offers $370,000, you're going to say, you know what, let's keep it on the market another couple weeks. Let's see if we can get another couple of offers. So home prices move up much quicker than they move down, and we haven't seen that breathing room in the housing market yet because we still have such a low inventory of homes. Why do we have such a low inventory of homes? Well, part one is because if you're a homeowner and you bought your home for a 2.5% or a 3% mortgage, you don't want to sell. Because if you sold, you got to go and get a 7 or a 7.5 or an 8% mortgage. So it's going to cost you a whole lot more. So a lot of homeowners are saying, you know what? I'm just going to sit tight in the home that I have right now and see what happens. And then builders are also confused because builders have to project out 12, 18, 24 months when they go out and build a apartment complex or if they build a neighborhood. And so they're saying, We don't know what mortgage rates are going to be like in 12 to 24 months. We don't know what the economy is going to be like. We don't know what the housing market's going to be like. So do we really want to take that risk and invest millions or billions of dollars into building this subdivision where we don't know how much money we're going to make? So you've been seeing builders kind of sitting on the sidelines, not sure what to do. All these things have created uncertainty in the housing market. Now, of course, hedge funds and investors are in influence on the demand side of homes because there are two factors that determine home prices and housing affordability: supply and demand. And on the demand side, that means how many people are buying homes. And if you have more people buying homes, that puts upward pressure on home prices. So now let's just say you have a lot more investors entering the home market. You have a lot of institutions entering the home market. What does that do? That means more buyers are entering the home market. If you own a home, that's great news for you because that means your asset prices rising, home prices are rising because you have all these buyers coming in. That's what we saw happen in 2020, 2021, and into 2022, even into 2023. But if you don't have the buyers, who does that benefit? It benefits people who want to buy a home because if there's no buyers out there, but you have sellers, that means the sellers have to compete against each other to be able to sell their home. And how do they compete against each other? By cutting their home price to make their home more attractive to a potential buyer. And so now if you want to be a buyer, if you want to go out and buy a home, you don't want other investors in the market. If you are a homeowner, you want investors in the market because that means there's more buyers out there. However, what we've seen over the last number of decades is investment ownership of homes hasn't really changed that drastically. In fact, we're still kind of at par of where we were over the last couple of decades. Yeah, it's a little bit higher than where we were in the early 2000s, but it's less than where we were after the 2008 crash. So you haven't seen this dramatic change in institutional or investment homeownership. In fact, if you want to go out and invest in real estate today, it's pretty unattractive because mortgage rates are high. Not just for people who want to buy a home, but also for investors. Because if you want to go out and buy a home to live in today, you might get a 7% mortgage. But if you want to go out and buy an investment property today, you're going to have to get an even more expensive mortgage because investment loans come at a premium. So now maybe you're paying 8%, maybe 8.5% on your investment loan. And that means now you have to get at least that return in order to justify that investment. And a lot of rental properties today are not giving you 9 or 10% returns. So you have a lot of investors sitting on the sidelines not sure what to do because investors who want to invest in real estate want to make sure they get a profit on their deals. And that's why many times the investors that are investing in real estate today are finding alternative sources of capital as opposed to just debt. What does that mean? Instead of going to the bank and paying 8.5%, which might mean you're not making any money, you're going to find other ways to fund your deals. Maybe that means you have cash, or if you're a hedge fund, maybe that means you take out a loan against your other assets. Now, before I explain what that means, I do want to let you know that if you are interested in learning more about how do you invest your money yourself and how do you build wealth yourself, we have a free ebook at Briefs Media called How to Build Wealth as an Investor that walks you through the basics of how do you build the mindset of an investor, to how do you invest your money, to how do you save your money, to how do you spend your money, and how do you earn more money. This ebook is a comprehensive step-by-step guide that will walk you through how do you use your money as a tool to build your wealth, and you can download this ebook for free. All you got to do is click the link down in the description below or go to briefs.co/ebook. Now, going back to the topic of alternative sources of funding, I want you to understand this when it comes to hedge funds because this can also create opportunities in the housing market. And the reason why is because let's assume now you are a fund that owns a lot of stocks, a lot of companies that are publicly traded. And now you finance this portfolio of companies, this portfolio of stocks that you own. And now you have this cash, which is debt, that you use to go out and buy real estate. Everything is good. You finance your stock portfolio to go out and buy real estate. But then what happens? Let's assume now that the economy takes a turn for the worst and stock prices crash. That means now, if your stock prices crash, the lenders for these hedge funds would say, we need our money. Now, what's the difficult part about real estate? It's not very liquid. So now, if you start to see your stock values fall and lenders start to call their loans, that could force potentially hedge funds to liquidate their properties, potentially do fire sales because they're not seeing the returns that they want. And if you were to see these fire sales, again, go back to the demand and supply, that would increase supply, which would pull down home prices. So while hedge funds buying homes can push home prices upwards when the markets are hot, it can also pull home prices downwards even faster when markets are not so hot. So I want you to understand how that dynamic plays a part in the economy, because we don't know what's going to happen with this bill. There's a lot of issues that could come out with legalities of this bill, but I want you to understand now what is the reality, because there's a lot of headlines talking about how hedge funds are manipulating the market, how investors are manipulating the market. Understand how things have been happening and how things are actually happening. That way you can make smarter decisions instead of just more emotional decisions about what's happening in the economy. That way you can make the best decisions for you and your money. The United States of America is facing one of the most unaffordable housing markets ever. But what if I told you that you can get paid to purchase a home? Take a look. President Biden and the White House want to give 500,000 Americans money to purchase a home. Now, to be fair, this headline by Newsweek and MSN is a little bit